These and all other managerial accounting problems can be found in Sarai's studies. The link is in the description box below. As always, I skip everything, just read the question. Should Pretty Vase Company accept this special order? Already I know this is a Chapter 12 special order problem. Remember that there are two types of special orders, one where there is idle capacity and one where there is not enough capacity. How do I know? Well, if I read the problem, the Pretty Vase Company manufactures vases. Its manufacturing factory has the capacity to produce 5,000 vases each month. Current production and sales are at 3,000 vases, so we normally do 3,000 vases. But if we read over here, we just received a special order for 4,000 vases. So if we normally make 3,000 vases and our special orders for 4,000 vases, that's a total of 7,000 vases, which is 2,000 more than we're capable of making. And so this tells us that if we were to accept the special order, we're not going to be able to do the special order and do what we normally do because that goes over capacity and we're only capable of making 5,000 vases. So what we do is prioritize our special order of 4,000 vases, and then whatever is left that we're capable of making, which is 1,000, right? Because out of the 5,000, we did 4,000 vases for the special order, meaning we have 1,000 left that we can sell using our normal rate. So this is a special order capacity exceeded type 2 type of problem. Personally, I don't even read the problem. I just see special order and I go straight into the chart. We have the capacity to produce 5,000 vases each month. There's no dollar amount for capacity. Then what do we normally do? What's our normal plan? Well, normally we produce 3,000 vases each month and we sell them for $150 per vase. So we produce 3,000 vases and we sell them at $150 each. And then what's our special plan? What are we doing for special order if we do accept it? Well, if we do accept it, we're going to be doing an order for 4,000 vases selling at $100 each. Now, as soon as I hear special order and I know it's a type 2 capacity exceeded type of problem, I'm going to remember my little Tetris shape. I'm going to have one thing here, and one thing here. So this section over here is going to represent how much money we're getting if we don't accept the special order. And then these two together are going to represent how much money we're going to get if we do accept the special order. So again, our little Tetris shape, we have our three little sections. And what we're looking at is what we do normally. What we're going to do is we do accept our special plan. But if we do accept our special plan, because this is a capacity exceeded type of problem, we can't do the normal plan as we normally do, no pun intended. We're going to have to do a new normal because we're going to prioritize, or we're going to entertain the idea that if we do take the special order, we're going to be producing 4,000 and we only have capacity for 5,000. So the only thing that's left, our new normal, is going to be 1,000 vases for $150 each. So our new normal will be 1,000 vases. So what we're looking for each of these is really just contribution margin. But the big question in these types of problems is, are we making more or less money if we accept the special order? So to answer that question, we look at operating income. But the thing is, the only thing between operating income is fixed costs, and they're telling us that if we do accept the special order, fixed costs are not going to be affected, which is why we just stick to looking at contribution margin. What's revenue? Well, normally we sell 3,000 vases, sell them at $150 each. So 3,000 times 150, that's $450,000. And then our variable costs, if you look at over here, variable costs that vary with number of units produced. And so the information that they give you, unless otherwise stated, is based on your normal activities. And so this is based on the normal amount of units that we produce, which is 3,000. And so we know variable costs is direct materials, direct labor, and then obviously other variable costs. So the sum of these three numbers, so that's going to be 198,000. And if we take the difference between those, that's going to be 252,000. Great. That's it. Now we're going to focus on what happens if we do accept the order. We're going to have revenues of 4,000 vases times $100 each. That's going to be $400,000. And then our variable costs, well, that's a little different because these variable costs are based on normal amount of units sold. But our special plan requires 4,000 units sold. So what we're going to have to do is find the variable cost per unit. So we could just multiply by 4,000. So if we do that for direct materials and direct labor, that's going to be 84,000 divided by 3,000 because that's what it was based on. So with the variable cost was $28, that was 30. And then this one is a little bit different because it says that these variable costs vary with the number of batches, not with the number of units produced. And so here's my key. I write whatever's here. So 50 times 480, that gives me 24,000. So this is the number of batches times $480. But the special order requires us to make vases in 75 batches. So our new number is 75. We keep this number the same, 36,000. So So that's going to be our new variable cost, and that is based on our special plan. The special plan is based on 4,000 units, and so 36,000 divided by 4,000, that's going to be $9. And so we get our variable cost per unit for the special plan. These numbers always stay the same, and this 75 comes from the new requirement here. So now I know that this is really just 28 plus 30 plus 9, and then times 4,000 because that's our number of units. That's 268,000 this over here, and so 400,000 minus 268,000, that is 132,000. And we're not done. Now we have to do the new normal. The new normal is going to be based on 1,000 units selling at a normal price 150, because again, that's the only thing we have left in terms of capacity since we already used 4,000 units in the special plan. That's going to be $150,000. And then variable cost, well, again, since it's based on normal, we can use our normal values. These normal values were based on 3,000 units. And so when it comes to normal, we do normal stuff. And so we divide this by 3,000 because that's our normal value. So 24,000 divided by 3,000, that's going to be 8. So we have 28 plus 30 plus 8 this time, and then times 1,000. So this is 66,000, so 150 minus 66, that's 84,000. Now remember, this is our Tetris shape. This is what happens if we don't accept the special order. This is what happens if we do accept the special order. So we want to add these, so 84,000 plus 132, it's going to be 216,000, and we're comparing that to the contribution margin that we're going to get if we don't accept the order. Take the difference between those two numbers. That's going to be a difference of $36,000. Let's analyze this. If we don't accept the order, we're going to be making a contribution margin of 252. If we do accept the special order, we're going to be making less of a contribution margin, which is not good. So taking the special order will negatively impact our normal sales because we will be losing $36,000. So the answer is no, we should not accept the special order because we will lose $36,000, and therefore the answer is B.